Welcome everyone to Waterfront's quarterly economic update. A few items as we get started here today. We'll be using the slideshow presentation that can be found on our news and events page at waterfrontadvisors.com. Also, we will have a recording of this meeting available on our news and events page after the meeting. There will be an opportunity for questions after the economic update, and please type your questions in the chat box and we'll be able to answer those at the end of the presentation. And we have everyone's lines on mute. So please use the chat box if you need something for us to address. And as a reminder, your video camera is on. Other participants will be able to see you. Today, we are joined by Chris Harrington, Waterfront Asset Management Chief Investment Officer, and Matt Hekman, Portfolio Manager at Waterfront Asset Management. At this time, I'd like to turn the meeting over to Chris Harrington.
Good afternoon, good morning to other folks on the West Coast. Happy to be talking to some of you for another time, just 2 weeks ago. And today we have a different focus. We're going to focus on the economy, not the strategies we offer. We are going to talk about a lot about inflation and the economic outlook. So with that, let's get started.
Good morning and happy Ammon Day. We've been celebrating in the office here with Ammon patties made by our own Chris Cricky. They were wonderful. Hopefully you get to celebrate as well. If you don't know what I'm talking about, you can look it up. It is Ammon Day today. And if you still are wondering what on earth I'm saying, some people call them almonds, but people that are in the know call them almonds. So happy Ammon Day. With that, I'll get started. So we thought we would start laying a foundation for our conversation today by looking at consensus forecasts. So this is a consensus outlook using or taken from a Bloomberg News survey of over 75 economists. The survey was taken in early February, so this is recent data. And you can see on the top line, on the far right-hand side, that global growth, GDP growth, is expected to be 4.3% in 2022. A deceleration from rapid growth in 2021, but still respectable growth. 2023 growth expectations are for some moderation down to 3.6%. On the line below, US GDP growth is in 2022 expected to be 3.7 before decelerating to 2.5. And you can kind of see the quarterly cadence to the left of the annual numbers, which indicates a slower start to the year with better growth in the middle and back half of 2022. Global growth, as I mentioned, is expected to be slightly better than US GDP growth. The next line down is important. The Consumer Price Index, or CPI, is a measure of price level or inflation in the economy. And as you probably all well know, because it's talked about frequently on news shows and et cetera, inflation is running at a very high level. Highest we've seen in many decades, actually. And the forecast for 2022, based on this survey, is for CPI to average 5% for the full year and decelerate meaningfully in the following year, 2023, to 2.5%. We're going to spend a lot of time over the course of this presentation discussing this part of the outlook because it is a significant, has a significant impact. And the forecast that we have here is a significant driver of the overall growth outlook and health of the economy. So a lot more coming there. As you look at the quarterly cadence, again, you'll see a similar trend. Q1 CPI is expected to be 7%. Both the December and January prints were right around that level, and then decelerate pretty meaningfully by the end of the year. So Q4 2022 consensus is looking for CPI of just over 3%. Next important statistic is employment, and you can see that the employment outlook is relatively positive. So the unemployment rate is expected to stay relatively consistently in the 3.5% range, which is a good number. Industrial production, just a measure of industrial activity in our economy, is expected to be relatively elevated this year, roughly 4% for the full year, and decelerate in 2023 to 2.5% number. Lastly, the interest rate environment, also something that gets a lot of attention in the current environment. Current consensus is looking for 4 25 basis point Fed funds interest rate increases this year, 1 per quarter. which would bring the lower bound of the Fed funds to 1% in Q4 of 2022. And you can see there that the estimate for the 10-year Treasury yield ending the year would be 2.25%. Again, these are consensus forecasts. We wanted to share these with you to set a baseline for the rest of our conversation. Each of us will share our perspective on growth and inflation and some of these other statistics as we go through the rest of the slide deck. Hopefully this is a good starting point, and I will turn it over to Chris.
Thank you, Matt. So what I'm showing you here in the graph is the consumer price index year over year. And what you'll notice in this graph is the gray bars, they are recessions. So when the blue line spikes up high, pretty much every time historically, there's one time in the 50s where it didn't happen, you end up with a recession. Why does that happen? Well, because as right now, if you look at inflation running at 7.5%, consumers need to spend in excess of 7.5% year over year. They need to spend 9 or 10% to generate actual real growth. That is hard to come by. Consumers just don't surge, their spending habits don't surge that much. So if we don't have a slowing in this inflation rate, things are going to get pretty ugly. And so we are paying attention to inflation a lot these days. I'll talk about a little bit about what has gotten us here. There are 4 main causes that have led to this surge in inflation. First one I'll talk about is supply shocks. On the right, you'll see the CPI categories, but the top is dominated by energy and autos. So it's well documented what's happened in the auto industry, semiconductor chip supply constraints, and other supply constraints have led to very low production levels. That created a surge in prices for used cars and even the prices for new vehicles. That is expected to improve as production comes back, but obviously the companies are going to try and hold price the best they can. And then in the energy sector, there was a lot of underinvestment, actually, a little before COVID, and certainly when COVID hit, a lot of energy companies just cut back quickly. I don't know if you all remember, there's a day, April 2020, where oil prices traded negative. And that just shows the dire straits that the oil industry was in back in early 2020. And of course, they weren't investing money in environment. And then when demand has come back, prices have surged. Now, demand has not come back so much so that it's well in excess of pre-COVID. It's just getting back to pre-COVID levels, but that underinvestment has created a good supply-demand environment for oil. There's other dynamics in play with oil. Certainly, Ukraine is in play recently, and some financial speculation. But so those are a couple supply shocks that are very important in the economy that's led to the inflation we're seeing. Next slide, please. Some demand shocks. So obviously during COVID, spending habits changed. Durable goods demand surged. Home furnishings, phones, TVs, those type of things jumped quickly, 20% or so. They've since leveled off, but they've leveled off at a higher level than they were pre-COVID trends. So that surge in demand for goods created a whole lot of supply chain challenges and led to high prices for a lot of durable goods. And what I'll say as well is for some of the service categories where demand was plummeting, it wasn't so much a scenario where if they lowered their prices, they could drive volume. There's the idiosyncratic factors related to COVID. So they didn't lower their prices. And so some of the service categories haven't really lowered prices to drive volume, where some of the goods categories have seen soaring prices. And we talked about this plenty of time before, that the Federal Reserve banks in the US and Europe and other places really pumped a lot of liquidity into the economy, an excessive amount, most people would agree. And that money has to find a home somewhere. A lot of it's parked on bank balance sheets, but some of it seeps out into the economy, and a lot of it seeps out into asset markets, and commodity markets have been the beneficiary of a lot of that money. This year, commodities are up quite a bit. Some of that has to do with Ukraine, some other factors, but commodities have actually done really well over the past year. And it's definitely a supply-demand dynamic in play there, but there's also some financial liquidity, some speculation that is occurring. And once Federal Reserve start tightening, some of that speculative financial money should subside a little bit. Lastly, talk about business confidence. Inflation has just became such a buzzword in 2021 that it's almost like companies felt they had to raise prices. They'd be left out, be the only ones not raising prices if they didn't. These companies are smart. They knew the government had provided a lot of funds, a lot of available cash to consumers, and many of them made the assumption that when these consumers are able to, they're going to have the wherewithal and they're going to want to spend some money. So we have some room here to raise prices and get away with it. I think that was a business decision made by a lot of companies, and sometimes it was irrespective of what the supply and demand picture was. So that is in play as well. Sort of the hysteria over inflation became a business opportunity. Sometimes you hear the statement, don't ever waste a good recession. Well, what that means is businesses should try and get a little more efficient with their employee base during recessions. So it's almost don't waste a good inflation hysteria period and get your prices up the best you can. And some of that is in play. Turn it over to Matt now.
Yeah, so as we look forward, I mentioned the consensus forecast. You see it reiterated on the bottom of this slide. The CPI of 3 to 3.5% in the fourth quarter of 22 obviously implies a meaningful decline. So as Chris just shared, many of the supply constraints widely are expected to get better. Auto production is likely going to improve pretty meaningfully. We think consumer spending, so the demand side of the equation, will start to normalize over the course of this year as economies here in the US and globally start to open up, and the opportunity to spend on services like going to a concert or watching a movie at a movie theater, et cetera, becomes more of an opportunity, becomes more available to consumers. They'll choose to spend there, which will take some pressure off of the spending that they've been doing in durable goods and help to balance the supply demand in that area. And then finally, global central banks clearly are in the process of removing monetary stimulus. And the Federal Reserve is widely expected to begin the process of tightening financial conditions by raising interest rates and potentially even shrinking their balance sheet. And so we're generally in agreement that inflation is peaking now. Inflation is likely to pull back throughout the course of this year, particularly as we move into the back half of 2022. And as a result, the Fed funds, while it does need to move higher, doesn't need to adjust aggressively. And so the consensus outlook for 1% Fed funds by the end of this year seems reasonable. Next slide. From a growth perspective, something that, and inflation perspective, something that we're also paying pretty close attention to is that over the course of the last several quarters, inventory builds have been a tailwind to GDP growth, as companies have tried to build back inventory that was depleted during the last, the recovery from the COVID period, as well as some underinvestment that obviously happened during the COVID recession. But as you can see in that bottom left-hand chart, the overall level of inventories as measured as inventory as a percentage of sales is still remarkably low. It's at levels that we last saw shortly after or during the recovery from the Great Recession. So the time period from 2010 to 2012. Essentially what that indicates is companies for the rest of this year and potentially further need to build back inventories in order to have available supply to sell to consumers. You've probably experienced this over the course of the last several months if you've tried to buy a vehicle, or if you have tried to buy furniture for your home. Even if you've tried to do a repaint project, exterior or interior, the availability of a wide variety of products has been limited, greatly limited. And this chart is just one way of showing the severity of the lack of inventory in the system. And so as we look forward, rebuilding inventories across the economy will be a tailwind to business production, and it will be a headwind to inflation. As supply increases, the rate of inflation should slow pretty significantly. Next slide.
So what these rising prices have done is really led to a sharp drop in consumer expectations. This is the University of Michigan Consumer Sentiment Index. And what you're seeing on the left is an index of consumer expectations. You see that has taken a pretty sharp drop over the course of 2021 into 2022 at pretty low levels. Now, this is consumer sentiment. You know, this is not what they're actually doing with their dollars. People may be unhappy about the price of an auto, but they still be buying it. So you just got to take that into consideration when you look at consumer sentiment indices, but still not a troubling sign. If we don't see prices start moving down, I'm pretty confident consumers are going to start balking at the higher prices and will pull back. They still have some savings that can carry them through for a little while, but these high prices stick around. We're looking at some very troubling growth conditions. And on the right, I'm showing you two pretty big areas on our economy: housing and vehicles. These are buying conditions for houses and buying conditions for vehicles. These are what consumers believe. You can see sharp drops to the right, and has to do with prices. Prices of autos have gone up to very challenging affordability levels. And pricing of homes has gone up to very challenging affordability levels. If mortgage rates move higher, the price to income ratios in housing is too high to sustain very high mortgage rates. So those are some trends we're watching. Wages for the past few quarters have been rising less than inflation. That's not sustainable over the long term. Wages need to rise at a greater clip than inflation. So if wages don't pick up or inflation doesn't slow down, this is a nasty cocktail that the economy won't be able to handle. In the short term, we've mentioned this quite a bit, consumers are in very good shape with savings. They do have the wherewithal to spend from savings, and that could help the economy in the near term if they choose to spend those savings. But eventually, wages need to be running higher than inflation or the economy breaks. And here's something that I want to raise. In an equilibrium state, wage growth should be equal to inflation plus productivity growth. So if wages are rising 5%, that doesn't necessarily mean inflation is going to be 5%. If you have a very productive workforce, that could mean inflation is 2.5%, but productivity is 2.5%. Workers deserve to get paid at an inflation rate plus the productivity that they are generating. Historically, our economy has had productivity around 2%, averaged about 2%. The previous decade was a pretty low productivity time period. That's very important actually, because the labor force, the way you get sustainable long-term growth is productivity and labor force participation. And the upcoming decade, we have very bleak outlook for labor force participation. Demographics and immigration are going to make that challenging. So growth is going to come from productivity. And there's a lot to be excited about there, but there's also some concerns there, and we are paying attention to those dynamics. But You see, I do want to just reiterate this point that when people say wages, oh, wages are going up 5%, that it's inflationary. That's not necessarily the case. If there's productivity behind those wage increases, it doesn't have to be inflationary.
Yeah, thank you for raising that point. It's an important one. We're going to shift gears a little bit here and just talk about interest rate outlook. Obviously, inflation feeds into forecasts for interest rates as well. But what we're showing in this chart is the yield curve, the Treasury yield curve. So comparing the 2-year versus the 10-year. And this chart goes back over many years, and you can see in times of normal economic growth or healthy economic growth, the yield curve or the spread between the 10-year and the 2-year Treasury note averages somewhere around 150 to 250 basis points, call it 200 bips. You can see over the course of the last 9 months, that spread has narrowed pretty significantly, which speaks to some of the concerns that we've been talking about this morning or this afternoon relating to inflation, as well as concerns over the more recent Omicron variant outbreak here in the US and globally, and its forecasted impact on growth. Going forward, we're expecting that growth improves, and we think this spread, this yield curve, is likely to steepen. That would be a positive indicator. Just to give you a sense of perspective, the consensus expects the 2-year Treasury note in the fourth quarter of 2022 to be somewhere around 1.69%. So call it 1.7. If you add sort of a normal 200 basis point yield curve spread between the 2 and the 10-year, that would imply a 10-year of 3.6 in the fourth quarter of this year. Consensus today is much lower. I think consensus is probably right, but we wanted to provide some context for where interest rates are today and where they could go if the outlook proves to be as positive as, generally speaking, the consensus expects it to be. Next slide. And then lastly, I just wanted, from my perspective, highlight the credit markets, which are an important area to watch for early signals of concern over the growth outlook. Typically, credit markets start to react to negative data a little sooner than other risk assets like equities. So what I've shown here is yield spreads or credit spreads in the corporate bond market at the top, and then in the high yield space in the bottom. And as you can see, both are suggesting that there's not a lot of concern priced into fixed income markets. Typically, as people get concerned about the outlook, the premium they require to take incremental credit risk starts to go up. And so that line starts to inflect upward. As you can see in recessionary time periods, those credit spreads blow out meaningfully, and they typically start moving well before a recession hits. And so this is an area that we continue to be focused on, but based on current data, it would suggest that the credit markets have a relatively benign credit outlook, which is a positive for the outlook, generally speaking. Next slide, please. And Chris, why don't you finish this up?
Okay, we talked a little about this in previous slides, but because of our labor force challenges over the upcoming decade, we need a lot of productivity growth to drive economic growth. When you think about people having savings, and savings can drive growth in the short term for a little while, but first off, there needs to be spare capacity in the economy for those savings not to lead to inflation. If people are just spending savings into rising prices, that's actually not real growth. But in the long term, growth really comes down to two things: productivity and labor force growth. And it remains to be seen. Automation, that's all coming. I mean, we'll be showing up at a McDonald's that has automated food servicing sometime in the next couple of years. Self-driving, well, it's been a little slower than people believed it would be. It's definitely coming. There's a lot of automation that's going to come, and that's definitely going to help drive productivity. But automation alone doesn't drive productivity. I believe you need a very functional government, which I'm not sure we have at this moment. to help drive productivity. There's a lot of dynamics in play. So we're paying attention to some of those things. And if we don't see a pickup in productivity, then it's going to be a slow growth decade we're looking at. And I'll just leave it at that.
Great, and I think we're gonna pause here and take some questions. Feel free to type into the chat box if you have specific questions you'd like us to address. Jonathan, I'll turn it over to you to narrate.
Yeah, we've got a couple of questions here. We'll start this one off. We'll start with Chris, and then Matt, you can comment as well. How does international political uncertainty play into this outlook?
Well, I mean, let's just go right to Ukraine with that one. Let's talk about that for a minute. Oil is obviously impacted. It's been bid up on this Ukraine uncertainty. A lot of wheat comes out of Ukraine. Ag prices are impacted in a big way. Palladium, 46%, I think, of global production comes out of Russia. That's used in some emission technology that's required on vehicles. There are a lot of materials that are impacted by the current situation. Within Europe, they get a lot of their natural gas from Russia, and natural gas prices have at times soared in this winter. There's some chemical companies in Europe that their plants have run negative this year in the past few months because they're just soaring natural gas prices. So there's a lot of dynamics in play. It's a tough situation right now, and we're paying very close attention to that.
Yeah, I would just say I agree with everything Chris said. First and foremost, it's a human crisis, and that's that. But from an economic perspective, in an environment where we're trying to fight inflation, events like this are not helpful, clearly. And so we're hopeful that we're able to find a peaceful settlement, that Russia chooses not to move forward with an invasion. I would say the other thing that's of significance that I would mention here is that the world is watching. And so it's widely reported that China has aspirations for Taiwan and taking Taiwan back to be owned by the country of China. And I'm sure they're watching carefully how the world responds to Russia's aggression in Ukraine and using that to inform how they think about the risk reward of potentially making a move there. So these are really important aspects and important for the outlook. In the end, we're obviously focused on the economic fundamentals that we've shared with you and the individual companies, the economics of the individual companies that we're investing in on a day-to-day basis. That's our focus. These other issues are something that are at the perimeter that we watch, certainly. But right now, the underlying health of the consumer, of corporates, and the supply and demand environment, which we think is going to improve, we think will prove more important than what's happening in Ukraine right now in terms of the outlook for risk assets.
Next question was, are mortgage interest rates expected to decline in 2023?
Well, it depends where they finish 2022, I guess. Just a broader note, the mortgage rates are largely based off of what the 10-year treasury rate is. A 10-year treasury rate has moved up to about 2.05%. And so that's mortgage rates have moved up accordingly. Our economy cannot sustain very high interest rates unless the Fed is playing nicely and buying securities, which I don't believe it's going to, be on the same side as the government in the upcoming year. Higher interest rates with 30 trillion in debt, if you assume that the Fed doesn't own securities, you're talking an extra 1% yield curve shift is 300 billion in fiscal deficit. Higher interest rates would break our economy. There's too much debt. So I don't see mortgage rates moving significantly higher because I don't see the 10-year moving significantly higher. Others may have a bit different perspective. I think you could see a modest move higher, but Matt may have a different perspective. There's all sorts of different perspectives. factors I missed.
Yeah. Well, I wholeheartedly agree. There's far too much debt in the system, predominantly held by governments. But our ability to withstand higher interest rates is extremely limited. One of the reason why we focused on inflation in this report is a very key variable to the outlook is if inflation normalizes or slows, that creates an environment where the Fed isn't forced to raise interest rates rapidly. You may have seen there are some firms out there, Goldman Sachs, I think, is the most notable, suggesting we could have 7 interest rate hikes in 2022. As we pointed out, the consensus of these economists is 4. If inflation turns down and rolls over, that takes pressure off the Federal Reserve and allows them to normalize interest rates. And when I say normalize, we're just wanting to go from nothing to something. Fed funds rate have been basically 0 for a very long period of time, and they're trying to normalize that environment back to something around 1%. And so in that environment, if inflation rolls over and the Fed is able to methodically 25 basis points per quarter raise interest rates and get us back to a healthier level of interest rates globally, and certainly for our economy here in the US, our economy, our consumers, our corporations, our government can adjust to that higher interest rate slowly over time. And that includes consumers with higher mortgage rates. And so I don't know that I have a point forecast for you in 2023 for where mortgage rates are going. But generally speaking, if this outlook plays out, the consensus outlook plays out, I do think the economy and consumers can adjust to a higher level of interest rates, including mortgage rates over time.
So what kind of adjustments are going to be made to the asset allocations of the portfolios that you guys are running? And are there any particular areas of opportunity that you guys are seeing?
You want me to start or you want to start? I'll start with, so I manage the Waterfront Balance Fund. And today the asset allocation between equity and fixed income is 68% equity with the balance in fixed income and cash. I'm committed to staying within a range of 50 to 70% equity. So I'm near the high end of that range. The reason for that is shown in some of the slides that we showed you today. I'm positive on the growth outlook, 1. 2, I think interest rates are going to rise, which is a negative for fixed income returns. And so that explains the positioning today. As I think about the most likely probable direction of growth in the economy and markets going forward, I think it's reasonable to expect that I will start to move the equity allocation lower slowly over time, closer to 65% and probably eventually 60%. One way to think about our economy is that a general rule of thumb, and it's just a general rule of thumb, it's not perfect, but a general rule of thumb is when the Fed starts an interest rate increase cycle, it sort of starts the shot clock on economic growth. Typically, once they start raising interest rates, they continue moving interest rates higher. And that process generally lasts for a year, 2, 3 years, depending on the cycle. Every cycle is different. But they've started the shot clock on the economy, and risk assets will react or move in advance of the outlook for the economy. And so reasonable to expect that my equity allocation today, 68%, starts to gradually move its way lower over the course of the next couple of years. Within asset markets, areas of opportunity, one that I'll highlight is I'm finding some pretty interesting, profitable companies that have reasonable growth that sit in the healthcare sector. Pharma companies in particular are an area that I've been doing a fair amount of work on new ideas. I already have a fair amount of exposure there. Eli Lilly is a significant position for me. There are other names that I'm looking at that trade at reasonable valuations that I think can compound pretty steady growth and are very profitable companies, throw off a lot of cash flow that they can use to create value for shareholders. So that's an area that I'm definitely doing more work on. Yeah.
Well, just a reminder of my strategies, not a whole lot of market timing going on, really not supposed to be going to high cash levels. So, I have 5 to 6% in cash in those, and that's pretty high. Really not, mandate is not to make big market timing bets. The mandate is to try and find the best securities I can that could generate some alpha through special situations, regardless of the economic growth environment. Outside of the strategies, I'll say that I think municipal bonds are starting to get very attractive, and there's a possibility they could get really attractive. Municipal bond market is a lot of retail investors, so it can be very volatile, especially when you get a backup in interest rates. You can get these just fast sell-offs and spreads blow out in municipal bonds. And those have proven to be really good buying opportunities in the past. So that's an area that I think has a lot of appeal as we face this inflation environment. And as we've said, that we don't think interest rates can soar because that'll end up breaking the economy. So there's some opportunity with municipal bonds.
Thank you, Chris and Matt, for your time today and for presenting this information. If you have additional questions or would like more information on Waterfront, please email trent@waterfrontadvisors.com. As a reminder, the presentation and the recording of this meeting will be on our news and events page. And this concludes our call for today. Thank you for your time.